This two-part conversation started with Omotola Abimbola, who is one of the investment analysts at Afrinvest, is live in the studios with us. Good morning.
Good morning, boss.
Hope you had a very nice weekend.
Yes, I did.
Okay, so let's look at the market's momentum without MPC across board, from equities to fixed income, currencies. So technically, folks are saying, do we really need MPC? We can't just do without them.
Well, we do need the MPC, although what we have observed is that in the last decade, the importance of the MPC has been more of form than substance, because outside of the MPC's purview, the CBN itself, has some monetary policy tools that it can use to influence the direction of the market. And in the last 2 to 3 years, the CBN has been relying heavily on that to influence policy direction. For instance, if you remember, towards the end of the administration of the former CBN governor, Governor Sanusi, the monetary policy rate, which is the main anchor rate that the MPC sets when they meet every other 3 months, that main policy rate wasn't changed the last 2 years of the administration. And even in the earlier part of the current CBN governor's tenure, the MPR was flat until it was eventually, brought down before being jacked up again. So essentially, with or without the MPC meeting, the CBN has some major policy tools, such as the Omo auction, the frequency of the Omo mop-ups, as well as the marginal rate or the clearing rate at those Omo auctions, to guide the direction of the market. And much more recently, the market has also been taking direction from fiscal authorities, because the domestic debt market is heavily dominated by the federal government. They are the heaviest player in the market. And in the last 2 to 3 years, they have sort of changed their debt strategy from a much more conservative, tone of foreign currency borrowing to a much more aggressive foreign currency borrowing, so as to reduce their debt servicing obligation. Because if you look at the reports issued by credit rating agencies on Nigeria in the past 2 or 3 years, by Moody's, Fitch, and S&P, the major concern has been that Nigeria's debt servicing obligation, as a ratio of revenue, it has risen significantly, up to about 50% towards the end of 2016. So there has to be a deliberate strategy to reduce that debt servicing obligation, so they can unlock, more borrowing potential and also improve on their credit rating. So taking a cue from this, the Ministry of Finance in the last 2 years, they have embarked on a deliberate strategy to reduce the volume of domestic debt issuance and increase foreign currency borrowing. So based on this monetary policy tool of the CBN and the fiscal policy strategy, the market has been taking direction as to where the use would be.
We will talk about, we'll break this down a little bit further, but in the conversation, Nigeria is not an exception in which you have the Monetary Policy Committee do nothing. 1 year, 2 year, 3 year, 4 year, sometimes 5 years in other jurisdictions. So if a Monetary Policy Committee do nothing, and sometimes some folks just say, hey, boss, your MPC doesn't do anything this time around, they will keep doing nothing. So when MPC, a particular MPC does nothing, what guidance, what is the benefit of this meeting regularly as scheduled on a calendar, even if all rates, parameters are left unchanged?
It is very important because the MPC is an independent committee of the Central Bank of Nigeria, comprising of 12 members, the Central Bank Governor, which chairs it, the 4 deputy governors, 3 members of the Board of Directors, 2 members nominated by the Central Bank Governor, and 3 others nominated by the federal government. Now, it is important as an analyst and for market participants to have an understanding of the thinking of the MPC committee members, so as to form a guidance as to where the direction of monetary policy is, and also understand their own assessment of the status of the economy. So when you don't have these meetings, right, it doesn't really, it doesn't improve, it has an impact on the level of certainty of monetary policy, because for most market participants, they will be making decisions without seeing the overall picture and the thinking of the MPC members. For instance, after every MPC meeting, there's usually a personal statement of committee members released. And this personal statement will give you a full understanding of the assessments of the committee members themselves, of the economy, and their own guidance as to where the experimental policy to be and where the economy would be before the next meeting. So it is very important to have these meetings to understand the thinking of the MPC
This
members.
minutes of the MPC meeting and the personal statements of each members.
Correct.
If we have a full meeting, 11 or 12 people. So we're having about 11 statements here.
12?
Of about 12 individuals. What that does, to break what you said out, is that it gives us an idea of what each of these 12 individuals think. Both, including those who are, well, quote and unquote, officials of the central bank,
correct,
and those who are non-officials of the central bank. And what does that do? And what does that help investors and everyone in the economy to do?
It helps with certainty and planning and appropriate forward guidance. As much as possible, if you would observe, most central bank governors all over the world, particularly in the advanced world, they have more or less relied on forward guidance communication in trying to point market participants towards their plans, right? And the reason for this is that when they make monetary policies, they do not want the impact of the policies to result into a shock in the market, right? So, which is why they hold these meetings, frequently, and then the chairman of the meeting usually goes out to address the press and give, appropriate forward guidance on both the the domestic economic development, as well as their own near-term policy objectives, right? So when you don't have these meetings of the MPC, what that does is that it doesn't lead to appropriate communication of the central bank's action to market participants, and that could create a shock. But luckily for Nigeria, the interesting thing is that since we haven't had the MPC meeting, we have seen the central bank governor come out frequently, to state his opinion of how the economy is performing, and also his near-term, monetary policy outlook.
That sounds very nice, soundbite for the television. But that, when the Godwin Emefiele speaks, he's speaking for himself and his staffers within the central bank, because he's the CEO of the central bank.
Correct.
But we don't have an independent view here of what Emefiele is doing with his colleagues behind closed doors. So the MPC is what makes that possible for us.
Indeed.
So we don't have that yet.
We don't have that yet.
So that means that this particular meeting and those comments in the communique or the minutes of the meeting, which should also guide not just investors but even the fiscal authorities, is absent.
It is absent, and it is a gaping hole because the interesting thing is that for most frontier markets, investors have come to recognize that political risk and political gridlock is a major risk that you cannot avoid. But when you start having political gridlocks and political risk affecting policy making, particularly monetary policy, you are pushing your luck, you are pushing it so far, and which is why for us we are very happy that the legislators have now
the National Assembly. You think they've pushed our luck too far?
Too far, because you don't want political gridlock to interfere with independent monetary policy making. The major reason why that's even the major reason why we even have the MPC in the first instance, to separate monetary policy making from the hands of political authorities. But now, when political authorities, due to their own differences, are now, taking some actions that is affecting the ability of the policy committee to meet, then it's a major risk to the economy. But I think it's been averted now.
We're looking at this situation, and of course, there are some costs, even though we can't put it in Naira and Kobo. But of course, we're paying some costs for this delay in terms of investors' perception. Now, we're talking about investors' perception from the outside world, whether they're doing portfolio or doing direct investment.
Perception-wise, it is bad, but on investor confidence, I would say this current event is happening at a very good economic period. It's happening in a period when we are experiencing, a growth upturn. It's happening in a period where we are having stability in external sector variables. Oil prices are stable, production volumes are up in Nigeria. We've been recording successive trade surpluses, current account is in surplus, external reserves are rising, and inflation rate is also coming down. So for most investors, amidst this plethora of very positive news, the only negative news from monetary policy, which is the fact that we're unable to hold MPC meeting, is sort of being, underestimated, in terms of their perception and their confidence in the economy. So even though we don't have an MPC meeting, the confidence of investors in the Nigerian economy and the financial markets still remains very, very robust because of the other positive news we are getting boost on the domestic, price development, the growth figures, and stable.
I got that. You said earlier in your comment that we shouldn't push, the Senate shouldn't push our luck too far.
We shouldn't push it too far.
Because, and I'm sure if we hadn't have a few things in our kitty, if we do our SWOT analysis, by now we should be sweating seriously when it comes to the fact that we don't have an MPC. But it looks like the groundswell had been there. So let's take us to the market. The equities market seems to just ignore the MPC. We had a rally from 2017 into early 2018, but looks like we are looking at the bottom of the barrel, are we?
Not essentially, not really, because for the equity market, the major driver in the past 2 years has been majorly macroeconomic fundamentals. When we had the downturn in oil prices, which affected, the FX rate and FX market liquidity, it had a negative impact on the equity market. But now, with the rebound in external sector variables and the improvement in FX market liquidity and much more policy flexibility on the part of the Central Bank of Nigeria since the introduction of the high and yield window in April 2017, we have seen confidence rebound in the economy, and valuation multiples on PE and price-to-book terms, they have expanded quite well because of the improving confidence in the economy. But also on the other hand, we have also seen very robust earnings in 2017 and even into Q1 2018, which expects. And that robust earnings is being driven by two factors. Number one, for the consumer goods companies, many of them, consumer goods and even industrial goods companies, many of them raised the prices of their products in 2017, because of the high cost pressures that they have experienced in the past quarters. And so that improvement, that increase in their product prices offsets the increase in cost pressures, and the margins are a lot better now. And for banks,
February wasn't really good.
February?
Yes.
For the equity market?
Yes.
It's not been good. And
yes. And March, we're a negative 3.22% since March the 1st. And year to date, we're now in single digits. That doesn't look good to me.
It doesn't look good because we are seeing a sharp correction in the prices of banking stocks and also consumer goods.
How long do you think this correction will last?
I think it will probably last in the next one quarter at least.
One quarter?
Yeah, and the reason is
we're almost ending this quarter.
The reason is this.
I'm looking at the Easter holiday, even though I'm going to still be here. But again, we're almost done with March.
No, I'm talking about the general sentiments in the market. Okay. Definitely, there will be some up days and some down days. The market should rebound very soon because of cheap prices, and people are going to be, taking advantage of bargain opportunities. Okay. But in terms of the short to medium term view for the market, the short term view is a bit bearish, because for most investors, they've become accustomed to very high dividend yield, which unfortunately they're not going to be having in 2018 because of the improvements in multiples.
Let's go there. We'll just you just finish that off for us after the break. Then we'll go into the fixed income. The key reason when we're looking at the impact of the MPC and the fixed income space. Let's come back to Omotola Abimbola after the break. You're watching Business Morning. Omotola Abimbola from Afrinvest was giving us his part of his playbook for the markets in 2018 ahead of the MPC and now beyond the MPC when this meeting eventually holds. That's now rescheduled or updated for the 3rd and 4th of April from Afrinvest. Thank you very much. And let's continue with that. What you're looking at for the equities market into the MPC and beyond the MPC of April?
For the equity markets, the current sentiments in the market is being influenced by two major factors. One is the skepticism on forward earnings, particularly for banks. Last 2 years, the earnings for banks have been quite strong, particularly for the Tier 1 lenders, essentially because of the high interest rate environment, which has led to an expansion in their net interest margin and also their interest income. And then there was a surge in trading income as well. In 2016, that surge was driven by FX revaluation gains. In 2017, we are seeing more derivative income coming for the Tier 1 lenders. Now, investors are now asking the question that with the declining yield environment in the fixed income market, and with the MPC already being anticipated to probably cut the benchmark rate by about 200 basis points before year end, are they going to impact on their earnings going forward? So that's a major concern for the banks. And then also, talking about the sentiments in the market in general, we had some pretty strong earnings results come out in the last 2 or 3 weeks, but the market hasn't responded to that. And we feel that the reason is also partly driven by the fact that the market has become so accustomed to high dividend yield. Because last year and 2 years ago, when banks declared dividend, yield is probably in double-digit region because of the very low valuation multiples then. But now, multiples are a lot higher, and most of that impressive forward earnings is already priced into valuation. So when you're seeing a dividend yield of 5% or 8%, for instance, it doesn't steer so much of interest on the part of investors. But one major consideration is that the alternative access to fixed income, to equity rather, which is fixed income, these have also declined. So last year, although you are getting dividend yield of 10, 11%, TB's rates were well above 20% for the 12 months maturity, say. But right now, yields in the fixed income markets have declined, and you should as well expect a lower dividend yield going forward. So it's going to take some time for the market to become, more accustomed to the
I can see you driving towards a cul-de-sac here. On equities on this side and fixed income on the other side, it looks like we're going into this dead end.
But we are still positive for the market.
I know you're positive, but this is a political year, quote unquote, 2018.
Correct.
So what's the playbook? For equities, should I sell in May 2018 and go away?
We believe that towards the peak of the primary elections in October, between Q3 and Q4, there will definitely be some volatility in the market because for most foreign investors who are used to investing in frontier markets, they realize that during period of election, there is usually volatility. If you take, for instance, the case in Kenya, when they had the election last year, there was a lot of volatility in the market. Same thing in South Africa during the ANC crisis. So definitely there'll be some volatility in the market because of foreign portfolio investors exiting. But we think that for domestic investors, that will be the best time for you to buy. Because after the election goes, they're going to come back to that same market that they ran away from during the election volatility period. So on a long-term basis, we're very positive of the market because earnings are improving generally, particularly for the consumer and industrial goods sector, and the cost pressures are also subsiding because of the improvements in inflation rates and stable FX rate environment.
Should I sell in May and go away?
It depends on your investment horizon. If you're a very long-term investor, I wouldn't say you should sell in May and go away. But if you have a very short-term, investment horizon, perhaps May is the best time for you to sell and go away.
How much window do I have here? We end in March. So technically, let's put March behind us and look at April, May, June, July. Then you have the political primaries, whatever, sometime around August. And September, we're looking at an MPC, if all go well, around September as well. So the window looks very, we just have about 5 months in between here before, for whatever I am interested in doing at the marketplace.
Yeah, definitely. And that's why we should expect to see a lot more primary market issuance, between Q1 and Q2, particularly for the equity market and also for the fixed income market, because investors will be looking to take advantage of the positive investments window, to raise capital, to raise fresh capital. But talking of the market in general, another consideration is that because of declining yields in the fixed income market, right, the cost of equity is also declining, and that will place an upward pressure on valuations. So although, the entire outlook looks a bit dim when you consider the political factors, on a valuation basis, there is a major case to be made for increase in valuation multiples because of declining interest rate environment. It's going to affect the cost of equity for most companies. So for us, we are still, a medium-term bullish in the market, but in the short term, there'll be some volatility that you cannot run away from.
Where is the, and I'm sure you have all this report as well, when it comes to bills and bonds, or what you call the fixed income, what we saw last week or the last 2 weeks in terms of the matured treasuries and those repayments by the central bank, by the debt office. Then we have a new calendar of the NTB and the DMO, and we look at the borrowing plan of the government for the market shrinking now almost on a quarterly, on a monthly basis. Is that some level of confidence for fixed income, even though yields is trending lower?
Yields are trending lower, and our expectation is that in the near term, they will continue to trend lower because of the two factors that you have mentioned initially. One is that monetary policy outlook favors easing, because of the MPC, the central bank governor particularly, he has made a case in the past that his major policy anchor is inflation rates. And we're seeing inflation rates declining. As of February, it's printed at 14.3%, 230 basis points above the current monetary policy rate, and that is going to continue to decline. Our whole year-end forecast is 11.3%. So on that part, that is an argument and a compelling one for monetary policy easing. And then on the other hand, the other major policy anchor for monetary policy is FX rates. They have a dual mandate, price stability and exchange rate stability. On prices, we are seeing positive developments. On exchange rate stability, we are seeing positive developments because of the increase in the surplus trade and current account balance we are experiencing, which is leading to higher accrual in the external reserves, as well as the increase in foreign currency borrowing of the federal government, also increasing accruals to the external reserves, as well as the robust autonomous private capital flows in the market. 2-3 years ago, or rather, let me say 2 years ago, the level of autonomous flow, the foreign portfolio investments flow into the market was very low because of the considerations of inflexible FX rates environments. But now, with a much more flexible FX rate environment, we are seeing better autonomous flow in the market. In the last 2 quarters of 2017, we had foreign portfolio investment rising to the highest level since 2014. So with the positive outlook both for the current accounts and for the capital accounts, that should continue to bolster the external reserves and continue to give the CBN the case to continue easing monetary policy. Although we haven't seen a change in the benchmark interest rates, the CBN's policy action through the use of its major policy tool in the last 1 or 2 years, that's the Omo policy tool, open market auction, both in terms of the frequency of the auction and the marginal rates or the clearing rate at those auctions, they've already indicated that they're on a policy easing path, and that should continue in the near term. The other factor to consider is fiscal policy. Clearly, if you look at the NTB calendar for Q2, and even the DMO borrowing plan for Q2 for the bond, they're already signifying they want to borrow less than the amounts that will be maturing. So with the increase in liquidity in the market, that should place, a lot, so that should increase the level of demand in the secondary market.
70 billion naira on Wednesday.
Correct.
That's what the DMO is putting on the table. You think this is a done deal?
It's a done deal because the demand will be very, very high, particularly for the longer duration bonds, because of the expression of increase in policy easing, and also with the increase in the level of maturities relative to the amount that will be auctioned. So there'll be lots of demand in the secondary markets as well, because for most traders, this will be the time for them to lock in yields, before we start seeing all those maturities coming in.
Take a look at this three. We have inflation now below 14. So looking at this and see how they interwove, and you can see where my yield curve is also heading around that direction.
Correct.
And NPR at 14. So there's a little bit of a convergence here for this.
True, they're converging.
Yes, so these three are converging. And I'm looking at, if I'm playing these three together in the second half of the year, what do I do?
What you should do is probably increase your fixed income. You should increase your allocation to fixed income markets because of the impending, or rather, should I say, continuous decline in fixed income yields that we're anticipating. Particularly if you have a higher risk appetite, we would even recommend placing a higher allocation towards longer duration bonds, because in a period of declining interest rate environment, they seem to outperform the markets, talking about the fixed income market. So clearly, the playbook would be to lock in your maturities right now in the markets before we start seeing further decline in fixed income yields.
Do you think the ground is being prepared for MPC when they eventually meet to do some form of haircut for the NPR?
Not necessarily. Like you mentioned earlier, it seems as if they're giving a guidance of probably an April meeting for the inaugural meeting for the year. But being the first MPC meeting of the year, I'm also taking into consideration the fact that most of the members at that meeting will be new committee members who probably need some time to understand the CBN processes, to also form their own opinion of monetary policy. I don't think they would like to shake the table yet. They would rather probably just hold on to the status quo and look at how and use the opportunity to also form their own opinion of the market before making any drastic. If I'm going into a meeting for the first time, right, we wouldn't expect me to vote for a policy rate cut. No, I probably want to say, okay, let me hold on for now and probably look at the development in the economy to make when I would have had better understanding of the CBN process and monetary policy before making a decision to cut policy.
So the April 3 and 4, if it holds as scheduled or rescheduled, will be a do-nothing?
It will be a do-nothing meeting because of the first factor I mentioned, and also because of the fact that the CBN, they've continued to communicate that their major anchor for monetary policy is inflation rates. Although we believe that judging by empirical data and even observation, their main policy anchor is actually FX rates. But give them the benefit of doubt. If they say the major policy anchor is inflation rates, and inflation is at 14.3% now, still about 30 basis points higher than the current benchmark interest rates, then we shouldn't expect them to cut interest rates yet. But if you continue to see a deceleration in the inflation rate, or what we call a disinflation trend, then we should probably see 100 to 200 basis points cuts in benchmark before the end of the year.
I'm looking at the tightrope that Godwin Emefiele and his team and his new team will face between June therefore. So if we're done with April doing nothing, we're left with June, right?
Yeah.
Yes. So we're going to have a meeting in June, technically speaking. So that leaves us just about 3 months before the political folks get into the party. Then some forecasters that will have to cut rate and also move it up to, moderate the electioneering spending. So if we raise rating or if we cut rate in June, do you think we will be able to reduce it if we cut rate in June, do you think we'll be able to hike it in September, or we'll wait till maybe November, December meeting?
I don't think we have to, because if we are cutting interest rates for now, if we are cutting the benchmark interest rates, it would be to align the benchmark interest rates with current market realities. Because if you look at the 9-month Treasury bills rates, which is typically highly correlated to the benchmark interest rates, whereas 11.2% for the 9-month Treasury bills, which is highly correlated to the benchmark interest rates, and the benchmark is still at 14%. So if we are cutting the benchmark interest rates, it should be to align with what's already happening in the market. So it wouldn't be premature at all. But like you mentioned, there's some key downside risk to the outlook for monetary policy, and one of them is the election season, because it typically comes with a lot of capital repatriation by foreign portfolio investors and
domestic spending.
And that's going to put pressure on FX rates in the foreign exchange market. But with the current level of external reserves at over $46 billion, that shouldn't be any trouble for the CBN, because last year the CBN spent about $20 to $23 billion intervening in different windows of the FX market. If you take that away from the external reserves you have now, they will still be pretty much above where they were 2 years ago, assuming no single accrual.
Whoever has money is the one doing the market. If you have the deep pockets, go ahead and do it. Thank you very much. And we appreciate coming here. First day of the week to tee off the traded week for us. Omotola Abimbola, investment analyst from Afrinvest. Let's come back to you after the break. You're watching Business Morning.